live, Zach.
All right, everybody. We'll get started here shortly. Give it 1 second, let everyone funnel in. All right, guys. So thank you all for joining us, as always, for the Self-Directed IRA Social. I'm actually really excited about this one, just because it's such a hot topic right now. You know, how to mitigate risk and coming in when dealing with inflation is obviously something that's on everybody's mind right now. So to get started, we're going to go through our sponsors of the week. So to start off, we'll introduce Krista. We'll start with Macan Investments. Go up here, say a few words. Just grab one of those. Yeah.
Can everybody hear me? All right. So my name is Ryan Landry. I work with Macan Investment Group. We do apartment investments. We partner with a lot of self-directed IRA investors. Love to get your capital working for you, create some long-term generational wealth. If anybody wants to take down my cell phone, I can give that out right now as well. So that's going to be 832-642-0341. If anybody needs me to repeat that, just let me know. 832-642-0341. We do all types of apartment syndications across the Southeast United States. Look for a 2 to 3x multiple in 3 to 5 year investment terms.
Perfect. Awesome. Thank you so much. All right, next we're going to bring up Katie Capital Investment, the man himself.
I'm Rick with Katie Capital Investments. You can get us at rick@kcifunding.com. Hey, now. We are private money and non-QM lenders, so we can fund your fix and flip, we can fund your refi, we can fund your ground-up construction, we can fund your multifamily, 5+, up to 20 doors. So we don't go all the way up, but that's enough. So we're pretty much investors lending to investors. So I think we've got as competitive rates as anybody. I do want to thank the Blink Lending for sponsoring this event. Oh, absolutely. And they run circles around us. So you want the big guys, you go to Blink, and with the little boutique guys, come see us. Thanks.
Awesome. Thank you, Rick.
Again, that's Rick at kcifunding.com.
If I'm not mistaken, Rick, you've been a Quest client for a long time, right? Oh. That's back in the day.
Us?
Yeah, Rick.
What was that?
So you've been a Quest client for a long time, right?
Oh, yeah. I guess when you guys left Intrust in, 2011?
Yeah.
Nathan and started, 2012? And I think we were one of the first ones in the door.
Yeah, back in the Intrust days.
No one better than these guys for your IRAs, solos, whatever you got. This is the place to be.
We'll hear more about it later, right, Rick? I mean, come on. Dude, it's my mic time. Inflation. Apps.
That's right.
There you go. Education sponsor. And you have me up here. Anyway, so my name is Gabe. I'm with Blink Lending and Investments. Our website, blinklending.com. Look, you have real estate or land or anything that can be collateralized in real estate, we will lend on it. That's essentially how we like to now word it, I guess. Swiss Army knife. Everybody's familiar with the Swiss Army knife? Yeah. Right, so that's essentially what we are doing. Of course, we have the private money side. We have conventional lending. You buy a house to live in. You buy a house to invest in. You want to buy, how about debt to service coverage ratio? How about, Rick, help me out. What else? We got bank statement programs. We got commercial. We got multifamily.
I use them for my primary homestead.
Nicole's the best. Easy, good clients are the best clients, right? Anyway, so Robbie, there he is. Poke his head out. Yep, colleague and friend and colleague. So no, that's about it. Any kind of scenarios you guys have, run it by us. We're right around the corner here. Well, here, but in the Heights, or check us out on our online. I mean, that's it. We have so many FAQs. We have explanations of every piece of material that's going to be presented to you through a closing, both conventional. Okay, I'm running out of time. Both conventional or private money, and literally anything you guys need. It's educational-driven website. We love it. We love Quest. Oh, who's going to the Expo? Raise your hand. Who's got Expo tickets?
There we go.
Well, of course you are, Bounds. I mean, come on, bro. It's a great event. Emmett Smith's going to be there. It's Friday. Yeah, but the whole weekend is great. Casino night. It is a wonderful multi-hundreds of people.
The multi-hundreds of people. That's right.
Yeah, I think,
Yeah, there we go.
it is. I know. It's going to be a lot of fun. Okay, I'm done. I could be up here all. Anybody have any questions? I'll answer them. Oh, sorry, Rick. My bad. All right. Oh, there he is.
I'll be brief. I'm Brett Moses. I'm with Real Property Management Preferred. We manage properties for investors. We have about 1,800 doors in Houston, and we're scaling fast. Our sister company, which is owned by our owners, Sean and Joni Wolfswinkle, is Texas Turnkey Properties, where we build single-family homes and duplexes for investors. We put qualified tenants in those homes, and then we sell the home to an investor. We have a couple of developments going on, so we too have a fund, and that fund, we have a webinar coming up. If you're interested in talking to me about that, I'll give you the specifics. It is a 9% annual return that is dispersed quarterly. We can go into that. We'll be right outside, so that's it for me. Thank you.
Awesome. Thank you so much. All right, next up, I know we have ZT Corporate. Are they here? Anyone here? Yeah, absolutely. That's right. So Disrupt Equity, Tariq Musa, come on up.
Hey guys, Tarek Musa, Disrupt Equity. We've got a deep relationship with Quest for quite a while now. We work with many Quest clients. Our background, hey, what's going on? So yeah, our background, we focus on multifamily. That is our bread and butter. That's all we focus on. We have everything vertically integrated in-house, from the investment arm to the in-house property management. We haven't had very good luck with a lot of property management companies, unfortunately, so we had to actually insource that and build it ourselves, and it's been very nice for us, actually. So our inception, if you will, is that we, like most people, got regular jobs, started making some money, wanted to invest it, did the stock market thing like most people, eventually got into real estate, saw how nice it was, scaled it up very quickly, got into multifamily, and at this point, by the end of this month, we should be at about $200 million that we've deployed for investors, and about $500 million of assets under management that we have deployed ourselves. That's aside from third-party property management that we manage on behalf of other people. So our unique piece, if you will, is that we are a tech-focused company that happens to be applying our technology to the world of real estate and doing a really good job of that. We have our founder team from the world of Silicon Valley, Microsoft, Silicon Valley, all that typical stuff you hear about when you think of technology. And then the finance side of things, like myself, I used to be in New York City with BlackRock. I'm sure you've heard of them before, right? So we're applying our technology to real estate and doing a really good job of that. And last but not least, I guess we recently did an analysis of all of our historical deals. Our average return annually is 50.6%. And if you remove the outliers, just because we're never going to promise that, it's actually closer to 35%. But realistically, we've never promised that either. We're very conservative with how we approach things, try to be very realistic and show, hey, we want you to be very conservative, very comfortable with the worst case scenarios. If you're good moving forward, then that's fine. We'd love to work with you and see what we can do. And you're probably going to be excited about what's ultimately going to come out at the other end of the equation, because we put our own skin in the game right alongside you every single time. So there's a line of interest. And yeah, if you guys are interested, happy to chat and see what we can do for you.
Awesome. Thank you so much. All right. Finally, we got Chris Brown. We got two more. All right, Chris, want to come up here with the? There you are.
How y'all doing? My name is Chris Bounds, real estate investment fund manager and top 0.3% growth leader with eXp Realty. I've done around 88 million in transactions over the years. Almost all of that's been my own personal transactions, my own investment transactions. And I've used with my wife, we've used over 19 million in individual private investors. That's individual investors just like y'all and a lot of other Quest clients to do many of those deals. Founder of Invested Agents and also Invested Equity. In a nutshell, teach folks how to build wealth and how to build passive income through real estate. I collaborate with other operators, especially multifamily operators and mobile home park operators. And for those looking for strong risk-adjusted passive returns secured by real estate, we help put your money to work. Just started a $100 million fund specifically for affordable workforce housing. We're going to be putting a lot of investors' money to work in those. So you can learn more about me and everything I just said at investedx.com. That's invested, the letter X.com.
Awesome. Thank you so much, Chris. All right, ZT, you want to come up?
Hello, hello. Thank you all. My name is Kevin Gandhi. I represent ZT Corporate. For those of you that don't know us, we are a company that specializes in healthcare and automotive investments. So we got a lot of real estate guys, and they're really good at what they do. But something unique about us is we're in the healthcare space. So freestanding emergency rooms, surgical centers. We started off one facility in Houston, and now we're looking to be the largest acute care provider in the state of Texas that's privately held. And also we have dealerships, so car dealerships that are, you know, the big brands, not the small lot, used lot dealerships. We have BMW, Mercedes, Mazda, Toyota. So those types of businesses that you don't typically have access to, besides outside the stock market, you can invest with us and get some good returns on that side.
Awesome. Thank you. All right, guys, so if y'all want to head up, all three panelists, if you want to come take your seats up here, we'll be happy to have you. Chris, Tarek, you want to come on up? Perfect. Thank you, guys. So I really want to encourage you guys, both here in person and if you're watching virtually, really engage with this panel. There's a lot of wealth of information here, wealth of knowledge. We have Rick, who, like I said, he's been with us for a while. We've enjoyed a good relationship with him, and Katie Capital Investments. We have Chris, who's done well over 100 fix and flips. I know, he's had a lot of success there. And then Tarek, who's in the multifamily space. There's a lot of information and knowledge here, so please take advantage. I'm gonna hand that to you guys. So to get started, I guess I'll ask the first question. And Chris and Rick, this is mostly geared towards you guys, but Tarek, obviously chime in. So with the market finally calming down, are you expecting a ton of foreclosures in the near future?
No, more than we've had, sure, but we've also had historically low foreclosure rates for a long time. I got started knocking on doors for pre-foreclosures. So hey, if that era or tsunami ever comes back, I'd be happy to buy more, but not necessarily seeing that in a short answer. No, ultimately it comes down to housing and low inventory. We just don't have enough to meet the demand. So foreclosures, sure, it's going to uptick. Is it really going to have a major impact on the overall market? A lot of people think 2008 when they hear foreclosures, the economy is not really in the same spot. So,
Awesome.
All right, slide time. Can you all throw that
Yeah.
foreclosure slide up?
Absolutely.
Y'all gave me a tip off that
Oh,
that
where are
was going to
they?
be a question.
Do we have those slides in this one?
Yeah.
One.
Oh, those were in there. Sorry about that.
They were there a minute ago.
Yeah, they were.
But I was going
Oh.
to, I'll keep talking to them while they find it, 'cause it's an interesting slide. This market's not like 2008
Yeah.
at all. When foreclosures, 2000, really, 9, 10, 11, 12, they were off the charts because houses were actually upside down. We had a bubble. Houses were upside down. There was negative equity, no equity in these homes. This is different. Most homeowners have equity. So it's hard to get in foreclosure. You have options. You can sell the property, break even, or make money on your house. So the number of foreclosures coming up is going to be disappointingly small to the investor community. There's still going to be some. The great thing about Houston is we're a big mixing pot, and we've got people that need investors to help them out of their problems, and if they don't help them fast enough, then they will go to foreclosure. There's probably a few homes that are upside down, but in this market, when you've had 40% appreciation in the last 2.5, 3 years, how do you not be able to sell your house for at least break even? So
Yeah.
it's going to be pretty small. We may not get that slide up in time, but it's an interesting slide on how that foreclosure volume has really tailed off.
Yeah.
I don't want to hijack the panel, but I would like to hear Tarek's perspective on the commercial side, just because how debt financing, it's structured very differently in multifamily. And I think he has unique perspective on those folks.
Yeah, so generally speaking, I agree with everything they've said. For the single-family housing side, it's a very different market than 2008. Not likely to experience a recurrence of that. But on the multifamily side, these are folks who tend to have their projects with a deadline, right? Usually 5 to 7 year time frame, sometimes a little bit shorter, but maybe on the maximum 10 years. What you find is you've had a handful of people, a lot of people who have been overly aggressive with expectations. They think that rates are going to stay low. They assume appreciation is going to continue to stay high. So whenever they got into the deals, they analyzed that they had very aggressive variables underlying that. What's happening though is as interest rates have climbed, as prices have increased, what you find is that the cost of borrowing obviously have increased along with that, and their NOI, their net operating income for the deal, has been squeezed. And folks who did not anticipate that, well, now they're going to basically be underperforming or not performing, if you will. So on our side, we put a lot of things in place, try to mitigate for these things, interest rate caps and so on. We have deals where interest rates have gone up and they're actually paying us now because we had that in place from a long time ago. But it's an insurance policy. But folks who did not have something like that, they're having to either give the keys back to the bank, which hasn't really happened yet, but over the next 24 months, we anticipate they're going to be squeezed, or they're going to have to do just exit early. In this case, in this level of the game, they don't usually have to do a fire sale, but they will have to sell it earlier in the process than they anticipated, which ultimately reduces the returns or expectations that their investors had entered when initially on the deal.
Awesome. So,
Let me just say real quick, this is the slide I was looking at. I wanted you guys just to see real quick. So you can see in 2009, 10, how that foreclosure rate was really high. If you were an investor back then, man, it was yummy. My biggest regret is instead of buying a lot, I didn't buy a whole lot. I had a chance to buy everything north of I-10 and Katy. Should have bought them. If I could go back in time, know then what I know now, it wouldn't even be fair. But the bottom line, though, is the houses we bought back then have more than doubled today. And we'll get more later about what inflation is going to do, but the same is going to happen. Houses are going to keep going up for at least the next 5, 6, 7 years.
all right. And Tarek, I want to kind of piggyback on what you said. With interest rates climbing, obviously it's getting more expensive to borrow money. So I guess, Rick, you as a lender, are you still lending at like a roughly 70% loan to value, or kind of have you changed your parameters when it comes to your lending?
Depends on what kind of lending. If you're doing refis, we can get up to 80% on investor refis, cash out refis. Rates have gone up. The last summer, we could get people into 3.49% 30-year fixed. No brainer. You bought that interest rate down, you did that, and I did that on a couple of mine. I got some late bloomers. In Houston, property values have skyrocketed, taxes have skyrocketed, so they call it the DSCR loans. You can't cash flow 80% 30-year fixed. The only way you can get your cash out is you have to do interest only. So we have different financing tools on the refis, on the buy and holds. So 80% of the people are doing 5-year interest only, knowing that they're probably going to refi in 2 or 3 years and take it because rates will go down after this. I don't know if it's going to be a recession. I'm not sure how we're defining recession anymore. But after the Fed gets the economy under control, rates will come down. It happened every time. I got a slide for that as well. Go to the one before one other one. That one. Every recession we've had, going back to the 70s, the rates got pumped up, and then you can see where the rates have dropped after the recession. Every time, and it happened this time too. We had rates after COVID. That was a blink of a recession. But like I said, we had rates 3.49% for investors. That is nuts. Most homeowners don't have that, much less investors getting that loan. Now that's gone, and they'll probably never come back again. But rates back into the 4s is certainly foreseeable in another 18 months. On fix and flip loans, that market has tightened up a little bit. For heavy hitters, we can do 100% purchase and 100% of rehab up to 75%. But for the heavy hitters, that's tightened up. 70% is it, with exceptions. So again, we can do private money or hard money. We do fix and flip loans across the country. So it just depends on the experience, FICO scores and such. But money's still out. The bottom line is, if the numbers work now, do the deal. You know, how many people are waiting for the prices to come down before they do something? Anybody waiting for prices to come down? Anybody waiting for rates to come down before you do a deal? Mm-hmm. This is the smartest crowd I've ever been in. Because if you wait for rates to come down, that house you wanted to buy is probably going up 5-10% by the time you buy it. So what have you saved? Nothing. And we're in a supply shortage still. We cannot build fast enough to even break even with the new housing formations.
Yeah.
For 5 years, we're still going to be, can't build enough. And in Houston, again, it's a great place to be an investor. This is a net what am I trying to say? Migration state. People are coming in. You got the millennials who want to buy. They're on strike right now because of the rates. But as soon as they get used to the new normal, they're going to be back in. I mean, these rates right now are rates we had back in 2018, 2019. It wasn't slowing us down then. Well, of course, the problem is now the houses are so much more expensive. But the rents are up. Salaries are up. I read where salaries are up 5%. Inflation is up 9%. But I don't know anyone getting 5%. Anybody making 5% more this year than they were last year? Kind of hard to find that. But anyway, that's what the government's telling you. That so the affordability rate hasn't changed much. So don't believe everything the media's telling you.
Yeah.
I'll let you guys talk more.
Yeah, Ferris, kind of on that same note, has the increase in the cost of borrowing funds affected your investment strategy when it comes to multifamily specifically?
Yes and no. I mean, in general, obviously costs have increased, but that said, we have such a strong track record and relationships with our lenders where we're actually still getting some pretty solid returns. I mean, we see some people out there getting 6-7% rates. We're seeing 5%. We just got quoted on another deal, 3.54%. So pretty awesome, right? Very good in this environment especially. So we're still seeing good opportunities, but I will say you're seeing a lot more junk out there than good opportunities. So we underwrite a ton of deals. I would argue that for all the markets that we're in, we probably underwrite more deals than anyone else out there. So what does that do? That gives us a lot of volume that we can sit there and pick and choose which ones are the diamonds that we want to go after that are worth pursuing, and all the other ones, just let them go, right? We're not willing to overpay. We're very strict about that internally. So there's deals to be had, but you're going to have to sift through a lot more junk to find them.
Awesome. So guys, any questions that you have out there? Anybody online?
No, not yet.
No? All right, perfect. So, Chris, are you borrowing more or less money right now from lenders to get your deals accomplished?
So almost any financial product that you're going to use today, it's less than the inflation rate. So I was reading a JP Morgan, it was actually, the title of the article is very relevant to this topic. It was basically how to beat inflation with your investments. The number one strategy that they said was real estate. The number two thing was it was relating to the financing, and it was talking about different types of investments too, not just real estate. But it said, like, if you're borrowing money for these financial instruments, like, you're probably paying a lot less than what you're going to be getting, especially when it comes to real estate. So I'm absolutely willing to borrow as much as I responsibly can to provide good returns to our investors with the assets that we're buying, which we're primarily kind of like Tarek. We're focused on multifamily. But going back to what Rick was saying, it does have an impact. Interest rates absolutely have an impact on affordability and cash flow and returns. You just can't, especially if you want to simple it down to a single family, you just can't cash flow the same deal at 80%, maxing out your leverage that you could in January. You just can't do that today. Or it'll be a lot more difficult to do that. So that is going to require more capital in the deal, which can maybe lower returns. It's just different. You do have to be responsible, but yes, still borrowing, still buying, still looking for opportunities. You can look at in the chart here, people were buying real estate every single year that you see that. And rates have been a lot higher than they are today for almost that entire chart. So people are still going to be buying. It's just on the deal. Make the numbers work.
Absolutely.
Funny little anecdote, and maybe you'll get a kick out of this. We have so most of our deals, there's an equity position where you get upside in the deal. Of course, you have skin in the game right alongside us. You benefit. But we have one thing that we had offered once where it was a fixed return, kind of like that, where it was a 10% fixed return, and kind of the point where you said borrowing is a lot less than the potential that you can get out of this. We had a 10% fixed return on that one, and we have a very wealthy investor. She had a line of credit that she took against one of her assets, whatnot. So she was borrowing at 3%, lending out at a guaranteed 10%. So she's just playing the spread. So very intelligent, very easy money for her. So she put millions of dollars into it. Go figure.
And this actually popped in my head too. The very first deal that rental property that I did a lease option in it's probably 2006. So I'm not sure what the rates were in that chart, but they're probably around the 7%-ish range around that time. I bought it subject to existing financing. The seller had his mortgage at like 9.5 or 9.75, which is an astronomical rate if you think about it today. But I bought the deal, and it cash flowed. Just that was the economics of the deal. And for the life of me, because I had no job, I was in college at the time, I could not refinance it into cheaper rates. So I just had to keep the rate. It cash flowed though.
So you got a question?
Earlier you said millennials are delayed buyers. What I hear is they're not buyers at all.
Here,
Contrary to what I believe is true.
So-
I can.
Yeah, I just want to repeat some of the people online said, mentioning how millennials, you mentioned they were late buyers, and you're saying, are they buyers kind of at all? Are they, are they just really going to be living in? Yeah.
So every generation since the boomers has delayed buying longer than previous. So Gen X delayed longer than boomers, millennials longer than Gen X, and then it's expected that Gen Z is going to wait even longer than millennials. Now, millennials were in I don't identify as a millennial, but I guess I am from a legal standpoint. But there's a couple different factors there. The way the housing crisis, depending on how old you were when that happened, it probably freaked you out a little bit. And the younger younger sector of millennials waited a lot longer than anyone else. And then two, because of platforms like Airbnb and now remote working environments being more commonplace, there's going to be a larger percentage of folks that they're going to be lifetime renters because they like the ability to work in Silicon Valley but live in Austin during the summer or during the winter and then go up to Colorado Springs in the summer, and then maybe they want to live in Miami for a couple of years. They can do that, and they can do that because they can just get short-term rentals here and there and never have to own anything, have that nomadic life, and still make good income. So there's going to be, and Brian Chesky, the CEO of Airbnb, was talking about that growing percentage within their platform of users that are just choosing to live that nomadic lifestyle. So I think you're going to have two major things happen here. You're going to have that will continue to grow, but it'll still be relatively small. And then you're going to have the affordability problem, which is a much bigger problem because home affordability has been mitigated due to low interest rates. It's a lot easier to pay astronomical prices for houses if interest rates are 2.25%. When they're 6%, not so much. So if you qualified for a $300,000 house in January, like I don't know the math off the top of my head, but you qualify for a much lower priced house today. Therefore, you have to rent. And it's not necessarily, I don't know if that's good or bad for the overall economy, but if you're a landlord, that's good because less buyers, more renters, that's good. Last point I'll make on here is Gen Z, they're just starting to enter the marketplace. They represent 86 million Americans, and they're the largest demographic that we have on record right now. The largest demographic we have on record, with millennials being a short second, is coming onto the housing market. They're going to be looking for homes, most likely to rent. And if you have a home and you got a home to offer them, good quality housing, you can be their landlord and you can take advantage of that. Couple that with low supply. What does that tell you is going to happen over time with housing prices?
All right. And we're kind of seeing that just from a Quest standpoint, right? We're seeing a lot more investments into multifamily versus just traditional single family homes. So I guess, Musa, have you kind of experienced that same thing? And with that increase in multifamily space? Like, is this the future of real estate investing? Is that where it's going to kind of skew towards?
I mean, look, at the end of the day, when it comes to just volume of deals, there's obviously always going to be more single-family homes than there are multifamily, just as a absolute numbers perspective.
Yeah.
From the value of them, I think single-family probably still beats them as well. But the reality is, it's harder to find deals that cash flow, right?
Yeah.
With everything that's going more expensive, from the cost of the property to the cost of the borrowing, it's going to be harder to find deals that cash flow. So a lot of people are going to be stepping back and saying, well, fine, maybe I can't do it myself. Let me step back and give it to somebody who knows what they're doing, who is able to find better deals, who is able to leverage their scale and experience and relationships, all the stuff that come with it, to say, well, I want to invest, because nobody doesn't want to invest. Just a matter of, well, how can I invest? If I can't do it myself, can't find a deal that's going to work, here, you take it, you do it for me. Yes, you'll probably give a few points in the process, but ultimately, getting a smaller piece of something is better than a lot of nothing, right? So I would say it may be something that you see a phenomenon that happens more and more. I would say at present, we haven't seen such a big blow up of anything just tied to those reasons. I think just we've seen a lot of investors come in our doors just because of kind of outreach that we're doing, frankly, but not necessarily because of the phenomenon of pricing right now. But I think what you're going to find is over the next maybe 24 months or so, you're going to find a lot more people kind of stepping back, and people who maybe didn't buy properly on the front end, they're going to have to kind of lose their shirts and to really learn the lesson and step back and say, okay, well, let me give it somebody who is quality. And what I'll tell you from my time, in the asset management world, BlackRock and so on, is the higher you go in net worth with person, the less they care about hitting a home run, right? Someone who's just starting their journey, they want as much return as they can get. That's fine. I know somebody making multiple $100 million a year, he does not care about the return. All he says is, give me enough to beat inflation, but guarantee you're gonna get that money. They want certainty of the return versus the dollar volume, the actual percentage. So there's something to be said about that, where in this case, you're going to be taking a step back and maybe giving some of the points back, the return, but you're gonna have the certainty of the likelihood of success that comes with it.
All right, I think it does, and correct me if I'm wrong, but I feel like just with the condition that the market is in, that some people who are the newer investors, they don't know how to navigate a market like this, and so they'll lean towards what is sometimes more passive investment by, like I said, giving it someone who they feel is more qualified to make those investments.
Yes, and I think also part of that is the fact that there is a shortage of housing out there. That's across the board for sure. I mean, we just bought a deal in Austin, and Austin alone, fastest growing city in the country now, they have 180 people per day moving there. There's only housing for 100 of them. Guess what that means? A lot of construction can't be built in time. Multifamily, we can scale up quite well. We started once upon a time in our business, we started with single family. There's a reason we shifted to multifamily, just because it scales really nicely, and that applies from the operator side as well as from the investment side.
Yeah. Awesome, guys. So any questions from you guys out there? Yeah.
Are you guys more long-term holders, or do you try to go in? What type of cap rate are you going in on these properties at, and what are you exiting?
Yeah, so he asked, are Asteric and Disrupt Equity, are they more long-time holders? What's their cap rate, and kind of what's their exit strategy as well?
Good question. So there's several pieces to that question. Maybe first thing I want to address is maybe just the cap rate, because people love to fixate on one variable versus another. And the question is ultimately, what do you care about the cap rate, right? How important is it to you? Because people love to kind of hone in on one thing, such as cap rate. And the question is it that important on its own? It's hard to understand that without context around it, right? If there's a deal that's underperforming, it's going to have a very terrible cap rate, which people want to avoid a low cap rate. But guess what? It's underperforming. That means there's a huge opportunity to improve it and ultimately get a huge return out of it. So in and of itself, it doesn't really mean much. But to answer your question, I would say, generally speaking, we're buying pretty good deals, but there's still opportunity for growth, right? Whether it be from a financial perspective or an operational improvements perspective. Generally speaking, these days, cap rates will shift, but I would say we're still in the 4 to 5 range. Some deals closer to 4, but it varies. Maybe 4.8 on the higher end these days, but it depends on the market too, right? We're across Texas, Florida, Georgia, the Carolinas, the Sun Belt part of the country, the Southeast region, if you will. So it's going to be based on the market that you're in and the asset class. A class versus B versus C class asset, you're going to get very different rates. So that's the first part. And what was the second part of your question?
The cap rates, and then what is
Longer term holds, right?
Yeah.
The long term hold. So, yeah, so for us, to put it simple, our goal is to double your money. Okay, let's just leave it at that. The time frame to do that, historically, we would present 3 to 5 year plays to do that. That was very realistic at the time. The price points justified it, and it was very achievable. Realistically, we've never held a deal more than 3 years. We've been always able to exceed expectations and hit the targets or exceed them in a shorter window of time. Now, that said, as prices have increased, as costs have increased, we're doing a lot of things to shift and try to be more realistic. And with our investors, we're never going to promise a home run. Yes, we're going to try to do so. We have our own money investor alongside, so we're incentivized to do so. But at the end of the day, we want to set expectations very realistic. So these days, we're looking at more of a 5 to 7, maybe even 8-year plays. But that's going to be the expectation. We'll double your money in that time frame, and if you're okay with that, then great. If we exceed expectations, you're not going to be disappointed, obviously. But we would hate to do the other way around, where we overpromise and underdeliver versus underpromise and overdeliver. So that's kind of been how we approach things. But generally speaking, we do look to hold things long term. Our time cycles are going to be somewhere between the 3 to 7 year play on average. But we've talked about options where maybe we even hold the deal indefinitely. But it depends on what you're looking for. If you're looking for cash flow indefinitely, your retirement, whatnot, that's a great way to avoid taxes forever, right? So there's definitely a play to do that where it makes sense. But I would say that right now in our journey, we are looking to actually exit deals as well, but that time frame is going to be 3 to 7 years or so.
Awesome. Any other questions, guys? So, Rick, I wanted to ask you, as a lender, do you feel it's better, I guess, or if it depends on, on interest rates, but do you feel it's better to collect points up front at a lower interest rate lending, or do you feel like it's better to rely on your interest rate for that return with lower points?
So the lenders make their money on the points. Most of us lenders were, the big boys in town. No one's got $100 million in their pocket. I don't have $10 million in my pocket. So we've got private capital. We got people that, so if you guys got money, not making any returns, and you don't want to go into multifamily, you want to go into single family duplexes and stuff. We take private capital, and so any lender is going to take money either from banks, insurance companies, private individuals. They're going to get money from somewhere, and they're going to lend it out, and they're going to make a little bit on the spread, and they're going to make most of it on the points. So you're always going to collect the points up front. Some people start off offering points on the back end and stuff, and then when they start getting burned, they realize they should have got the points up front.
Yeah.
So all your tried and true lenders are going to charge points up front, and but most lenders don't make that much on the interest. Yeah, and we're talking about the fix and flip loans.
Yeah.
If you got a 6-month loan, you're not making much on the interest. So it's just the points that really pays the bills and the lights and stuff.
Yeah.
And then it's just a matter of, I think on average, 2 points is the average. You'll have people charge 3, people that charge 1. There's games they play. So all lenders got the different, it's kind of like poker. They got the different hands they'll show. But at the end of the day, it's amazingly how close it all is the same.
Yeah.
Just different ways you slice the pie up.
Okay, and so I guess this is kind of addressed to all three of you. Over the years, with your experience, has the steps you've taken for due diligence on any of your investments, has it changed now versus a couple of years ago when the market was really hot? So Chris, Rick, if you want to start, you have Mike, Chris, whatever.
I'll start and let these guys go. If you don't learn quick, you're out. So you get better as you start doing deals. And so besides due diligence, we have a pretty neat little private lender community where we get together and share notes. And, I call it the good, the bad, and the ugly. We don't know who the good, bad, and the ugly are in town, right? So there's a lot of fraud out there. And there's guys, I know guys I've got taken for $750,000 and such doing private money lending. Other guys, it's got, so yeah, you have to learn pretty quick on the due diligence. I think one of the best I've heard is Abe. Is Abe still around? Blink does a great job at their due diligence. If you ever hear Paul or Gabe talk, they're really good. But whether, it doesn't matter who you are, if you're going to survive, you've got to be good in your due diligence. You're going to learn. And we do a lot more now than we did when we first started.
Yeah.
I think we're a lot better at it. And you always get better at it too.
Yeah.
Yeah, I mean, personally, my strategy's changed over the years. It went from rentals to flips, and then now it's back to holding properties. So that obviously changes. But it's funny, like early on, like you're so nervous to even like do a deal. Like you want to do a deal, but you don't know what you don't know, so you're very cautious. And I remember the realtor I was using on the first deal that my wife and I did. He was like, you are the most cautious investor I know. And this goes back to what Rick was saying. This is back in like the 2010 era where, like, in hindsight, because I remember looking at a deal and I was like, dude, like, this is below the cost to build the house. Like, what's with all these properties? And I kept asking him questions. He's like, you're the most cautious investor I ever know. In hindsight, I wish I bought all of them. But so it went from very cautious to being a bit more aggressive. Then you get burned. And they're like, okay, well, don't do that again. So how can I put a check to where you check for foundation? I can put a check for checking for termites and all these things. So it's just a constant learning process in the due diligence. But starting out, what I tell folks is underwrite a property or two a day, every single day. And eventually you get to a point to whether you're buying them or not, you get to a point where, like, when you see one, like, you just know it. You know this is a pretty good deal. You get that quick assessment you can do pretty much in your head or within a couple minutes. And it's a little bit more complicated with multifamily, but I'm sure it has a similar vibe to where when you see a good deal, you just recognize it just because of the repetitions. When you start swinging the bat long enough, you know that when that good pitch is coming, you can hit a home run.
Pattern recognition, right? So, yeah, on our side, we obviously buy to hold these deals for the most part. So I think what's changed, we've always been pretty diligent about this, but I think what's changed is in the past, we had a margin of safety to ensure that, you know, should we be off by a certain factor, we'll be okay. And in the past, what's also happened is that we used to have to rely on third-party data sources or third-party property management companies, right, using their data, their information. That's fine. What's happened over time is we've shifted things to where we've insourced it. So now we have our own boots on the ground. We have the true data, whether it's doctored or not. We can't tell from it when it's a third party, but you know we have the true boots on the ground, and we built out systems and teams and technology to get data on an accurate basis. So it's not something that's updated maybe once a month. We update it quite literally on a daily basis. So we know exactly what's going on. For example, that deal that I mentioned in Austin. Whenever we initially bought the deal, we assumed we can bump rents about $300. Now we have more boots on the ground, more data on a regular basis. We're expecting actually to be closer to $900 increase, but that's not what we underwrote. So, you know, obviously our investors are probably pretty happy at that. But that's pretty interesting. So for our deals, whenever we actually get into a deal, our due diligence consists of literally going through every single unit physically, boots on the ground, walking them with our team to document exactly what it needs and knowing for sure what the actual cost is going to be. We bring the contract teams out on site that same day so they can give us a real bid, and they may need a day or two to put it together, but they can see the data for themselves, not just, hey, I kind of need this, maybe a little bit of that, you know, you're the expert, you tell me, right? So they get to see it with their own eyes. And then also on the contracts, the actual lease agreements, we go through every single one and document exactly what that consists of. Because what you'll find is a lot of people, whenever they try to sell the deal, they want to make it look pretty, right? So they might say, yeah, it's fully occupied, it has 100% or 98% occupancy, that looks great. But guess what? They fill them all up in the last 6 months with some crappy tenants that aren't going to last. You're going to have to end up evicting them, which ultimately it's going to impact you in a couple months, but at the time of sale, it looks great. So you have to be very diligent about that side. Who are the actual quality tenants? What looks normal over the life of the deal? And then what can you expect going forward, right? So I think the difference has been that we've been a lot more diligent. Instead of saying, yeah, we'll budget $3 to $3.5 million for this kind of service, we get out there and we see more specifically, okay, this actually costs 2.9, whatever. So we know exactly what the costs are going to be, and then we have our teams being on boots on the ground, so we can know for sure with our own eyes what to expect. And then the other thing too that maybe I didn't mention is that I mentioned that we were vertically integrated, but aside from the investment arm and the property management arm, we've also been able to build our own insurance company and financing company. So it's pretty interesting. And what's nice about that is that, and again, this is leveraging technology. So for example, we have a partnership with one of the best multifamily insurance guys in the country, probably one of the top 5 guys out there. Great guy, doesn't know how to build business. We do. So that's where we got involved. And what's nice is what used to take him probably 3 to 4 weeks to underwrite a deal, get it bonded and insured, and all done with, used to take 3 to 4 weeks. We're doing it now in 6 minutes. So it's incredible. What that does though, we've grown that business significantly, and we get to see the data of all the other players out there. So obviously there's a level of anonymity, so you know it's fair and it's not any sort of private confidential data, but we get to see in aggregate what's going on, not just in the markets that we're in, but also other markets. So whenever we look at a market and say, you know, that looks like a pretty attractive market, well, let's see what others are actually doing, because it's not something that they're pitching to somebody. This is real data they have to provide to the insurance companies, to the banks. This is real data, right? So this is as accurate as it can get. So we can get an idea and see what are the patterns and determine, well, where do we actually want to go after? Where is it worth going after? And how should we set expectations relative to the market? Are we in line? Are we being overly aggressive? Or are we being overly conservative in this room to move up further? So that's kind of been the shift, if you will, over time for us.
Okay, so From the investor side, like if you're looking to invest into a syndication, kind of what, as the investor, should be your main focus when you're doing your own due diligence? So Chris, Musa, either one of you guys?
The operator. It's 100% the operator. The operator first, deal second. And you have to always look at it in that order, because a good operator can take a mediocre deal and do pretty well with it. A bad operator can take an excellent deal and lose all your money. So absolutely, quality operators, really, I mean, every deal has risk, every opportunity has risk, but ultimately, if you've got an operator that has a successful track record, let's be completely transparent here. Anybody who just got started in real estate within the last 10 years, we don't really know a rainy day. Like, it's been a good run. I'm in that boat. Not sure about them too, but I'm in that boat. Now, I have an experience. I've flipped around 200 houses, so I have seen business plans and executed and gone through the full motions on them. That's given me some experience. From an economic cycle, I pull on people who have that experience, whether it's third-party advisors or other folks, operators that we collaborate with, and then just data in general. And then, of course, you've got various risk management protocols that you can put in place. But ultimately, operator first, deal second.
Yeah, I think that's pretty fair and well said. I think, maybe the underlying thesis around all of this really comes down to how do they make their money? Are they selling you a dream, or are they selling you a partnership, a true partnership, right? And this is where, again, we have our own skin in the game. So if you fail, we fail, right? And that's how we get paid. Yes, we have some fees up front to make sure we can cover the bills and keep the lights on, but the engine is running, and we make our money mostly if the deal is successful. And if it's not successful, then we lose out a lot. We have, this is probably not new to any of you, the whole preferred return and so on. So ultimately, if you don't make at least a minimum of X%, we don't get paid anything. So there's aligned incentives at the end of the day. But maybe to kind of build on Chris's point, for those who know us, you may know that we have a partnership with Open Door Capital. For those who don't know, Bigger Pockets, I'm sure you guys have heard of them, largest real estate education platform in the world, right? The face of that company is a gentleman named Brandon Turner. Maybe you've heard of him. We have a partnership with them. And where that came about is Open Door Capital, they focus on mobile home parks. That's their investment arm. They've done a really good job of that. The challenge that they run into now is that there's not a lot of mobile home parks that exist in the country that they haven't really tapped into that meet their criteria. And frankly, most states, most cities, they're not issuing more permits to build more mobile home parks. And for most places, they kind of see mobile home parks as an eyesore versus they would rather have an A-class office building or a multifamily complex, something that's ultimately going to bring some sort of economic development to the area. So what Open Door Capital has done, they decided that they want to keep growing and expand into multifamily properties. But they don't have the resources, the relationships, the connections to do all that, the processes. So they figured, let's just find the right partner to work with. Now, from that, with the platform of Bigger Pockets, they have access to pretty much every operator in the country, quite literally. But they went on a whole due diligence process, talked to as many as they could get their hands on, and determined who is the right partner. The three variables they were focusing on were, number one, who has a track record of success. I think that's pretty much a no-brainer that has to be there. Number two is the ethics of the person have to be there. And this kind of goes to the operator piece, because ultimately, no matter how good the numbers may look that are your pitched, if you don't trust the person who's giving you the numbers, then you should probably think twice about giving them your money, right? I think it's a no-brainer again, but it's pretty amazing what you see out there. And then number three, of course, is the ability to scale into the future. If they've had one or two home runs in the past, cool, but can they do that consistently in the future? So those are three metrics they focused on, and from their due diligence, they narrowed it down to really two people in the entire country they're willing to work with, and we are the primary chosen horse. And I think there's a reason for that. And obviously I'm a little biased here, but I don't think you necessarily get to raise and deploy $200 million of other people's capital without something to back that up, from a track record perspective.
Awesome. So guys, any questions from y'all? If you got any, guys, please, this is a panel designed for you, all right? So if you've got any concerns or anything at all, ask away.
Just curious, how are you sourcing, finding deals right now in this market? I look on LoopNet, CoStar. How are you guys finding these off-market kind of opportunities that make sense? And are you guys also looking to develop as well?
And
Find opportunities to buy value-add product in a particular market?
yeah, so we really asked, how are you guys going about finding deals that are off market?
Sure. So in our case, most of our deals actually are on market in some capacity, and not necessarily given to the broader market, but they all go through brokers. When you're playing with deals this size, most owners, at least at the scale that we play, which is usually 150 units and larger, upwards of 500 units in a single deal, right? It's rare that you're going to find an owner who's going to say, yeah, let me just give it to somebody off market versus let me give it to a broker who has all the relationships and can give me the best bang for the buck, right? The most value out of it. So in our case, a lot of our sourcing comes through relationships, and there can be some deals where the broker will preempt sending it to the market and just let us buy it directly because they know we're reliable. And a lot of the people on the other side of the table who they're selling, they usually have some sort of time frame that they have to meet. For example, if they're coming up on a 7-year project and the end of that is coming, well, they got to sell. There is no chance to hold and just wait for a better deal. But they want somebody who's going to be certain that they're going to be able to close. Certainty to close is probably the most important variable in our business here. And they're willing to take a cut of several $1 million to ensure that. So in our case, we have a good track record behind that. We have the relationships. They know that we've never failed to close on a deal. We can raise money pretty darn comfortably. So that's a lot of how we get brought to the table in the first place, and people come to us, as well as in our technology piece, we've developed the whole process where we really look at more deals than anyone else out there. And I think part of where the value in that comes from and how it's really benefited us is that in the past, call it 2-3 years or so, everything has gotten more expensive, including real estate, obviously. Multifamily is no exception to that. And what you find is that there's also been a lot of other people with all the capital that's flowing around out there that they have entered the game, either as a newcomer or they just never really knew what they're doing long term in the past, and they've just gotten lucky. And the reality is, it's not that hard to put together a couple $1 million between you and some buddies and whatnot. Everybody in this room can put together a couple $1 million. What does that allow us to do? When you get the loan from the bank, you can buy a $10, $20, $30 million property. Not that difficult to do. And a lot of people have been doing it. And the problem is that some of these inexperienced people, they're willing to bid up these properties to prices that just don't make sense anymore. They can pitch whatever they want to the investors, but in reality, we know it's probably not going to pencil out, but their investors aren't going to know that until 5 years down the road, and they realize that, wow, I was promised 20 plus, but it's only 13. What the heck, right? You lost the time, and there's really no recourse for that. Mm-hmm. So in our case, we look at a lot of volume to ensure we can pick those diamonds, like I mentioned earlier. But what's also interesting, too, and how we've evolved, is that we can raise money no problem, like I've said. So what that's allowed us to do is play at a much larger level. Anybody can raise a couple $1 million. That's not hard. It's hard to raise tens and 20s and hundreds of millions of dollars. So what that's allowed us to do is play at a much larger level. We still look at smaller deals, right? But the problem is most of those just don't pencil in because the prices are too high. At these bigger levels, 50 million and above, let's call it, it's very quiet. There's not a lot of players. The only real competition at that level are going to be usually more institutional-based people, right? Folks who, generally speaking, they know what they're doing. They've been in the game for a long time, and they're pretty greedy with their returns. And you know what? We're happy to take those returns and give them to our investors. So that's going to be a pretty interesting way for us to keep evolving and growing. Now, that said, of course, you have to have the buy-in of the lender and people who are willing to give you that kind of capital and trust in you. But we've got the experience and track record and the reporting behind all of it, and they've been comfortable doing that. So that's been an interesting way for us to kind of evolve into that game and how we're being able to continue to source good deals even as prices have gone more expensive and the market has gotten a lot more competitive. But maybe the thesis of kind of your question, it usually does come through relationships of sorts. We're not really going off market, sending letters or anything like that. It may be possible, but I think that's probably going to be, 100 units of lower, if you will. That's probably the max I can imagine would be most common in this game. But anything above 150, it's probably going to go through a broker.
Okay. And Chris, with fix and flips, how do you go about finding the properties that are most attractive for you, kind of in the markets that suit, kind of your parameters for your investments?
So personally, I'm not looking for fix and flips, but anymore. I'm looking for collaborative partners, folks like Disrupt, that we can work with and provide a good return for our investors. But I do work with a lot of single-family investors still, and ultimately, it all revolves around communication. How are you communicating with your target audience to tell them about what you have, so if it's a good fit, you can do business with them? And ultimately, it's going to revolve around some form of marketing and branding. Now, the good thing for real estate investors with a potential real estate slowdown, or it is slowing down to a slight degree, and we'll see what happens going forward, is as inventory rises, it should add a little bit more inventory for us all to play with, right? But ultimately, you're going to have to communicate with that other side and share your service with them. With single family, most of that is off market. It doesn't have to be off market. I was talking with Haley before this started, and she was talking about, and I don't know if it was on market or off market, but she was just saying that there was a unique thing on why a property wasn't selling, and they were able to make it work for them, but it didn't work for everyone else, and they got a great investment property out of it. So that's ultimately how it is, whether that's through direct mail, through I hate to mention cold calling and cold texting because you got to be careful with that kind of stuff. But pay-per-click, organic content, TikTok, YouTube, knocking on doors, all of them work, all of them don't work. It's all a matter of knowing your numbers, knowing your KPIs, following through, having a good sales process. But beyond all that, you still need to maintain a branding play outside of your direct marketing play. That's something that you have your pillar content, whether it's on Facebook or whether it's on like YouTube or your website, that ultimately attracts. Because there's two types of marketing. You've got your outbound marketing, that's you reaching out to them. That's mostly going to cost you in time or money. And then you have your evergreen marketing, which is something that you can put out there once, but constantly provides leads, provides folks coming to you. And I do that personally through specifically YouTube and blog content. And I transcribe my YouTube videos into text, which makes it searchable on Google. So we have a constant amount of leads. Now you can do that on foreclosures, you can do it on evictions, you can do it on raising private money, which is what I'm doing now, to make sure that you have that constant flow of leads. It's a slower process, but you can also do them both simultaneously.
And Rick, as from the lender side, how do you go about finding? Everyone wants money, obviously, but how do you go about finding your qualified borrowers that you feel comfortable lending to?
I just wait for the phone to ring. And no, we've been actually pretty blessed. We don't do that much marketing. The only thing we do is send out some email blasts every now and then. We've just grown organically with referrals and stuff for most of our money. So we've been blessed in that. I guess the thing that we've been blessed with is that my CFO and head hook and bowl, I don't mention my name, I've got to go find a way to, she's our bottleneck right now. She can only handle, a couple $1 million every 5 minutes. I got to get her to where she can handle infinite money. But no, we've just been doing email campaigns and masterminds. I guess a lot of our growth really has come through some good mastermind groups. And that's how we've been able to, we got pocket of investors in Indiana, we got pockets in the Carolinas, pockets in Florida, some in Wisconsin, and of course Texas. But a lot of that has come from masterminds. So I do encourage people to, it's going to cost you a little money, you probably go to the first one for free, but really join these different mastermind groups. And surprisingly, you're going to see Quest at almost every one of them, because these guys are plugged in to every mastermind, I think, in the country. What's a mastermind? That's a group of a group of like-minded individuals.
It's a club of sorts.
It's kind of that. So the ones we've been in, we focused on more of the faith-based real estate crowd. So we're in a couple of those where it's real Christian-based. One was Haley knows him, Tom Olson, with good success. It dissolved during COVID. That was amazing. The members in that one were amazing. Some of the Eddie Wilson, which you might have was in with Tom Olson. We've had.
Is this a website? Is this
No, that one's gone. There's Collective Genius. There's a bunch of different masterminds. Worth trying out if you want to go. They usually let you go for almost free or not much money, and then after you go, then they're going to hook you, and they're going to want a lot of money. But it has been worth it for us. But it's like anything. You can go to classes, you can do stuff, you can leave here. If you don't take action, it doesn't matter. You're wasting your money. But you meet the right people, get the right connections, you take action, your life will change. And it definitely has changed our life. I can tell by Chris, I knew him when he's a pup. He must have been at some masterminds, and he must have grown.
We met at Starbucks in Katy or something like that, and I don't know how many deals he funded, but
His dad loans money to us. I guess your father-in-law. Father-in-law. Throwing a little money with us, and we've been invested his money and such. So, it's a small. Once you get out there, it's a small world. But then there's different type of masterminds. All right, there's guys that are, they call them masterminds, they're really not. But then there's really the good nation. I like the nationwide ones because you're going to get different, diverse, and to grow these masterminds, you've got to come.
Google it?
So maybe if I may, I think your question is, what is a mastermind? Not what, to be clear, what it is a group of people that share a mutual interest in something, right? So in this case, in our case, for multifamily, there are masterminds that focus on multifamily. How do you do syndication? So I get to get there and chat with other folks who are syndicators or fund managers, people who are effectively, it's a type of networking group, but usually they're all in the same business in some capacity where they can chat shop, right? They can talk shop and discuss things. See, what are you doing? What are we doing? How do we learn from each other? How can we perhaps partner together, right? It's a bringing like-minded folks together to hopefully build something out of that. Either learning or some sort of business that actually develops. Some of them are face-to-face, some of them are Zoom, some of them they actually go to other countries or destinations to get together. The whole point is spending time together to chit-chat and network and share your thoughts amongst each other.
They can help you grow. You want to go face-to-face because you're in the mastermind session, but all the magic happens at dinners, at the coffee bar. I mean, there's just things you're not going to get on Zoom. You make these relationships. Sometimes you'll go out and have a field day. We'll be on the lake or something with the group, and you develop these relationships. And when you develop relationships with important people, they can help you with your business.
That's why I'm here.
Right. So part of the beauty is, the reason I like the national masterminds is if you're going to grow, you have to kind of bare yourself. You have to kind of get naked about your business, and you'll have one or two problems, and you'll say, I got this problem, I got that problem. Most likely, there's someone in that group that's conquered that problem and can help you or give you contacts and stuff. So you get the right group. And how do you find them? I asked different people Expo, the Quest Expo we had before COVID. Tom Olson, the guy I mentioned, was at the Expo. I met him at another mastermind I just happened to go to. He says, hey, I'm doing this I joined, we joined, went up there for free, got hooked. You go to Expo, you're probably going to meet some folks there and ask them, are you in any masterminds? Which one's in? Do you like them? Is it helping you out? So it's kind of almost under the radar. You don't really see them out there, but once you start looking, you'll see them, and they'll go anywhere from maybe $10,000 a year to $50,000 a year to $100,000 a year to join them. So it's depending on which ones you're in, but you'll be a millionaire.
Yeah, there's a bunch of masterminds that go over all kinds of different types of investments. So you're really just about finding the one that fits you.
Maybe
so
Derek. Derek knows about most of them.
Yeah, he knows about a lot of them.
The Quest guys really kind of know. Maybe you can visit with them offline, and because they're in almost every one of them. Haley's got quite a few for her day.
Yeah, we're gonna move. Ask a couple questions from the audience.
Go back to something that Chris talked about earlier, I think Rick touched on it was, when you have these single-family rentals or maybe even a duplex and you want to hedge your bets on the rentals, you talked about Airbnb and the guy that does that. But do you guys have any experience or knowledge about multiple roommates in a house in a manner way to hedge your risk on these rentals?
That's called single room occupant, SROs.
SROs, right?
Single room occupant. So I'll plug my buddy Diego Melo with Strata Ventures. They're really pushing what I call the pad split model out there. Right? That's just a particular company, right? But the generic term is SRO, single room occupants. So that's big in certain places. It's got pros and cons, but you can definitely get the right location and you can crank the yield on those. They're a little tricky when you go to the lending and refinancing. So you need someone like us. I don't know if Blank does it, but since there's a sponsor, I always got to go plug them. But we can do it, but there's a way to do it because not many people lend on SRO properties. So there's a way to do it. So if you want, you can contact me afterwards. We can have a coffee or something. I can kind of discuss the ins and outs of SRO. But that's getting real popular with some investors. It's been around, but it's just it's been around forever. Right. I mean, when I was in college, right, we were SROs.
Years, but, I was with mental health housing, and there were SROs, right? But it was different because the state provided the payment for those.
Right.
Now it's individuals sharing tax for themselves. I I'm not used to that animal.
Yeah.
Oh, you had a question over there?
Yeah,
Oh.
so first of all, I want to thank you guys because, it's a lot of good information. The topic for today was, how to protect, right, your money against inflation. So I just was wondering if you can give some practical, quick tips on things that maybe we should all be doing as far as what we're doing with our money or what we should not be doing as we're preparing for whatever's coming.
10 seconds on yours, and I'm going to address that. Just be careful with HOAs. So when you get multiple unrelated members in a home, probably might violate HOA. Regarding Airbnb, a Supreme Court case, which I was talking to Haley about, Tar versus Timberwood. That's Tar versus Timberwood. Go look it up. I interviewed the attorney that tried it. It's like good. Like that case won, the landlord won. But there's a unique thing, and it addresses your point. But Tar versus Timberwood, go look up that court case and read the summary. Ultimately, cash is trash. Like if you got cash, if you had $100,000, or say you had $1 million in your Quest account in 2020, and you're scared, like things are blowing up, like the world's going to end, so you did nothing. And then 2021, now everything's just too expensive, so you still did nothing. And then here you are in 2022, things are a little cloudy now because now we got a recession coming in, and you're still not doing anything. That $1 million that you had is now worth about $840,000 now, ish. And it's not that you still have the $1 million in the account. It just has less buying power today, and that so far is going to continue to trend. So for every day that your money is in your account, not invested, it is being devalued. Get rid of it. You've got to put it into assets. Now, do the financial responsible thing of having emergency funds and whatnot, but ultimately buy real estate. This is what I'm doing, so it's not financial advice. I'm not a CPA or anything. I think you're a CPA, right? So there you go. Buy real estate. It is an inflation hedged asset that happens to also provide a strong cash flow if you buy it right. Provide cash flow. You're basically getting someone else pay off your mortgage while the property goes up in value over time, and you can use accelerated tactics by whether you're going to refinance later on and take the equity to buy multiple properties, or you're going to sell it and basically do the same thing, or 1031 it to not have to pay or defer capital gains, or go into opportunity zones where you can potentially pay no taxes at all. Ultimately, you've got to invest. You've got to invest. If you keep your money just sitting in your account, you're going to lose it. And if you don't want to do all the heavy lifting, like the operational work, like if you don't want to go out there knocking on doors and all that stuff and go in flea-infested houses or make 1,000 cold calls or go underwrite multi-million-dollar apartment deals, lend your money out to folks that will do it for you for a good return. Now, look at the person you're working with, like underwrite them, but that's just the passive way that you can invest. And you can do it either through debt, where you're basically loaning your money out. That's what the $19 million I gave when I was in the sponsor section. I've used $19 million. Almost all of that has been from a debt position where I need to borrow $100,000 to buy a deal. I borrowed it from you, went and bought the deal, fixed it up, sold it for $150,000. I made $50,000. I paid you $100 back plus interest. But there's also equity, and you typically see equity investments usually in the multifamily space. It's not exclusive to. I mean, there are a lot of other ways you can do it, but that's where maybe you are getting a certain yield or preferred rate, but you're also getting some of the upside. So that way, when the property's sold, you get a piece of the profits, and you share in that too. So you can do it actively. Takes a lot of time. Great rewards. But if you're busy, you don't have time for that, or you'd rather just yield someone else's expertise, you can do it passively, which is, that's where we all play.
Let me add on that. Well, that was good, because Chris is absolutely right. You got to get your money working. If it's in the bank, you're losing 10% or more. I heard someone say, I forgot who the economist was on the radio. The way they calculated inflation back in the 80s, the 9.1 we have now, it actually been 17.3. Inflation is worse than the government wants to say it is. So cash is trash is absolutely right. If you're trying to save your way to retirement, you're backing up. So nothing else, lend it. We'll take it. Chris will take it. Drake will take it. Buy assets. A lot of people wonder why are hedge funds paying so much for the properties? It probably don't even cash flow. But if by the way, we have a meetup here last Wednesday every month, and I was showing an example of if you're breaking even, you're still, depending on how much money you got in the deal, but this was a deal where, that person had like maybe $12,000 left in the deal. They were still making 38% return on that single family just between the appreciation at 4% and the principal buy down that the tenant's paying. So you just look at appreciation. If you're getting 10%, it's nuts, right? You start adding positive cash flow to that. So if you've got, I was one of these guys, I had an oil and gas job for 40 years, but I always had a side hustle. I think most people probably started that way. Buy assets. If you don't know how, learn how. Education is important. Quest does a great job. Strat Ventures, there's other people in town that can teach you the ropes. Learn how to do it, but you're gonna make a lot more money buying assets. But if you can't buy assets, you're too busy. And people are busy. You got 2 kids, you got soccer, you got baseball, you got football. You're busy, right? Church. Then give it to one of us. We'll get that money to work, and at least at 9-10%, at least you're going to maintain, keep up with inflation.
And beyond that, I got one other point. So how many realtors in here? Any realtors? Okay. All right. Hey, we got one. Anybody else full-time in real estate, or your spouse does not have a full-time job? Anyone else? Okay. So there's something called, and he can talk more about it. You can ask how it applies to you, but it's something called a real estate professional. It's basically a check-the-box thing on the IRS on your tax return that gives you the greatest tax benefits that you could ever possibly have. It's like the greatest gift the IRS gives, and that's to real estate investors. There's certain things that you need to have to qualify, and by need to have, I don't mean a realtor's license. You don't need that, but there are certain things that you need to be doing to qualify for it. But if you do, it gives you virtually unlimited losses, passive losses, and how that can relate to your income and other business income and all that. That's the part where you definitely want a good CPA to iron that out for you. But it's a massive, massive benefit. So invest, and if you do it right, especially since you raise your hand, you're a realtor, you can end up taking advantage of some pretty good tax benefits.
Maybe to that point too, think about it this way. As a consumer, inflation obviously hurts you quite a bit, right? But the best position to be in is as a business, right? Because ultimately, you take your increased costs as a business and you just pass it as higher prices to the consumer, right? I think it's pretty straightforward. Now, the beauty of real estate is that the question that underlies this premise, depending on what business you're in, is how sticky is that product? If it's something that people don't really care about, well, then you probably can't survive an increase in your prices. People aren't going to buy it. Real estate, people need it. And COVID, if it showed us anything, is that the government is even willing to step in and guarantee that they're going to pay for the real estate, right? People work from home now. If they're more dependent on this. When you buy, at least in the multifamily side of things, you're buying a business. Every single property is a separate business. So anytime our prices increase, contractor, labor, materials, whatever it is, we pass it on as higher rents. It sucks in some capacity, depending on how you look at it, but it's also part of how business works in general. So that's the best way to hedge in a big way. But to that point too, the other beauty of real estate as well is the fact that what we have over a lot of other businesses out there is that we have taxation benefits, right? Depreciation, all that sort of stuff. Without fail, every single year, Q4 comes around, we start getting hit up by a lot of wealthy people saying, hey, I made a lot of money this year. I don't want to pay taxes on this. Guess what? You give me $1 million, you can now offset that against your income. Tell me how you can save that much on your taxes if you're in the highest income bracket, what, 20, 30, 40% in an instant, right? Now, obviously, with this year being the last year of bonus depreciation, if you can get half of that as depreciation in year one, you roughly 40 to 60% depending on the deal. But this is where the biggest inflation hedge really can come from, ultimately having a way to pass on those expenses to other folks, the consumers at the end of the day.
Any more last minute questions, guys? Yeah.
Rick, you mentioned something about inflation. So I guess there was adjustments that were made in the 80s, and then there's adjustments that are being made now, right, for inflation, how it's being calculated?
Yeah, I don't know exactly what the changes were.
Yeah.
You know, they still play, even today, they got what they call core CPI and CPI. That takes advantage of, you know, if energy prices are in there, food prices, they'll take stuff in and out, right? You know, our inflation is here for a while. There's no cure for energy.
We can see Carter interest rates.
Now, is there any chance I can get the next slide up?
Inflation.
Any chance I get that other slide? I don't know if
Yeah.
you can put the other slide up. I was going to, there it is.
No.
All right, so if you look, this is what the Fed did in the different recessions to curb inflation, right? So these are the different recessions. Everything, you know, the 2008, 2009 is an anomaly. But look where we started from. We started from about 0, right? So now we're up to a whopping 2.25 to 2.5%. The Fed's raised up to 2.5, which is almost nothing. So that's not really putting a dent in anything right now. So a lot of people are saying, well, we need to wait for the time to run out to see what it's going to do to the economy. Well, rates are all-time low. They're only planning to go to 3.5. If they have to really go up, they're talking maybe 4.5%, which is below the 5. I mean, below the 5 here.
Are we gonna see Carter's 17% inflation?
No, because that's what you saw over here, right? So you were that era, and it really wasn't Carter's fault. It was the guy before him. It was this idiot named Byrne. I forget the guy's name. He was the Fed guy they had before who just ignored inflation. But anyway, that's a different story. But no, we're not going to see that. We're going to see, now, who knows? I mean, there's black swan events. There's all kind of things that's going to happen. But the Fed believes that their goal is to jack it up to about 3.5%. They may have to go 4.5%, depending on what inflation's doing. But we got some black swan events kind of hanging over us out there. One of the biggest ones, Russia, if they cut gas supplies off to Europe, that would definitely send Europe into a big recession, which would have some fallout to us. And there's other little black swan events out there that could happen. But if things go as planned, that that maybe a 4.5% interest should do it on the Fed.
One is Pelosi going to Taiwan.
And you got Pelosi going to Taiwan. Those are little potential triggers, right? It's trying to take over Taiwan. There's little gotchas out there hiding in the weeds. Not having a real strong administration worries me. Things can happen, but from all indications, this is going to be fairly mild. In Houston, we're not going to feel a whole lot. We're so diverse. In the mortgage industry, they've already had 100,000 layoffs in the mortgage industry, right? So
Is that nationally or is that?
that's naturally.
Nationally.
That's national. Rocket Mortgage, all these big mortgage companies, because these rates went up, the refi boom was most of that volume, and that went to 0. So some mortgage companies have just shut their doors. So if you're that person, that's a recession to you, right? Not a recession to me, because I'm pretty much I'm busier than ever right now. But it depends on But in Houston, we did all this great stuff the last few years without the participation of energy. Now energy's back. But the mortgage business is down. There's other businesses that are down. There's always going to be winners and losers. But Houston's going to, I just thank the good Lord I'm in Houston doing real estate. I think this is one of the best places on earth to be doing it. What's that? We're more diversified. That's a huge. There's always people. Like I said, there's people that need help. There's always stuff out there, but that's just based on the data. We got the odds of getting much more than 4.5% are pretty low. But this inflation is going to be stingy because of energy for the most part.
Awesome.
May not go that high, but inflation can.
Well, the inflation is at 9.1 now, right? That's because energy is where it's at. Energy is affecting everything, not just, the price you pay at the pump is minimal, right? Okay, so what you pay $30 a month more, $40 a month more in gas. That's not going to change your lifestyle a whole lot. But every good and service that you get has an energy component to it. Your plastics, if you're food delivery and stuff. But on one hand, Walmart reported, right? Earnings, I don't know if you pay attention, they got a surplus of inventory. That's anti-inflationary because they got too much stuff. But other people haven't got enough stuff. Lumber prices come cratering down. Copper prices have come cratering down. So that's good for builders. But that's that's inflationary because now builders can build more cheaper, and so it's not going. There's things that are slowing the economy down. And there's things that aren't slowing it down. The Fed's got, in my opinion, they've got their work cut out for them. This inflation, getting it down to their goal of 2%, isn't going to happen quick. It's not. There's no way it can happen by the end of the year. They'll be lucky to get it down by the end of next year. So
They printed so much money, the balance sheet is extremely large.
that's, I mean, well, not only us, but between us and Europe, it's $10 trillion out there, and they're still adding on.
Yeah.
So it's, there's a lot of moving parts on this one. I just wish we had different administration in there. But they knew, I mean, but before this, I can't really blame everything on the one guy. When they started doing this money because of COVID, they knew they had one or two problems. Either they're going to have to put a lot of people on the street, or they're going to have to print a lot of money to save people from going on the street.
They started going on strike, and that's what caused it.
And the decision was, there's two devils. It was better to deal with inflation later than it was with having all these people get thrown out of their houses and apartments and such because they couldn't make the payments. So that was a conscious decision they made back then, and they admitted it. But for this administration to say inflation was going to be transitory, and I mean, it was like, what planet were they coming from? They knew this. It was easily predictable. So anyway, I go on. I'll shut up on that one because.
Guys.
I asked a question almost of fine, say there's inflation. What does that change for you, though, at the end of the day? The reality is, it's not just a U.S. phenomenon. This is happening globally, right? So where are you going to go instead? Probably nowhere else. You're probably going to stay in the U.S. regardless, right? The other factor, too, of course, is it's not just inflation in of itself. Corporate profits are at record highs now, so ultimately.
Paycheck to paycheck, but 61% of the population is.
Sure.
It's affecting them.
Sure.
61% of the population is being affected. Fortunately, I'm part of the other 39.
For sure. So over time, though, as that consumer demand comes down because they can't afford to buy stuff, ultimately it will come down over time, right? So there are factors at play that over the long run, kind of to your original question, are they going to see levels back in Carter? I think that's unlikely because ultimately this is a global phenomenon, not just a localized matter. And I think you're going to have these matters where there is reduced demand that comes as a result of it, which is going to ultimately pull the prices back down. And I think you also have the benefit of the fact that we are coming up on an election cycle. It's not popular to kill the economy. So you're going to have some stuff that are going to be promoting in things that are going to be favorable towards the economy and getting things resolved in some way. But at the end of the day, in regards to what do we actually do based on this information, regardless, the most important thing is to invest, right? And I say that because ultimately, timing the market is more important than timing the market, all that sort of stuff, right? And I think one interesting study that I thought was probably one of the most interesting ones that sticks with me is Fidelity, right? One of the huge brokerage houses out there. They did a study across all of their historical clients to see what was the most successful strategy for people. And the number one reason for people that had made the most money with them, percentage-wise, of course, are people who died, people who passed away, and they've basically held their investments without selling or fear and exiting and so on. So timing obviously was great. And then second most successful strategy was people who forgot their passwords, so they couldn't even log into a trade if they wanted to. So I think there's something to be said about that where ultimately there's only so much you can control, but what you can control, of course, is deploying your capital to put it to work, to do something rather than lose money just sitting on the sidelines.
Yeah. Well, guys, thank you so much for coming out there. Any more last minute questions? If you guys want to share your contact information, any events that you guys have coming up, feel free. Chris, we'll start with you.
InvestedX.com, InvestedX, the letter X.com. We do a lot of events. The summer's been a little light, been pretty busy, but we'll start picking up events in September. And I attend a lot of events. I'm sure Tarek will talk about an event that you might find me at some point. So.
And so Katy Capital, we have a meetup here, like I mentioned, the last Wednesday of every month. It's called the Houston Burr Community. So it's about how to make money and how to keep money. Sometimes, well, I've kind of got, everyone started stealing my stuff. I started talking about this stuff 4 months ago, and then now everyone's talking about it. I just give little updates these days. I'm not the only one. I mean, I stole it myself. No one made this stuff up, right? I just stole it a lot earlier. Stole it from the feds, right? So we were stealing this stuff before everyone else was. But we have guest speakers and stuff. But it's all around, buy, renovate, rent, refi, and repeat the Burr community, right? So if you want to know more about that, that's a great learning experience, great networking. We've got builders, we got investors, we got wholesalers. So if you want to be in that community, it's a great meetup. The room's usually pretty packed that Wednesday. I'm surprised. All I do is send out a couple of emails, and then we'll get 40, 50 people over here. So just have my stuff in the back for this, my little email brilliant strategy right there, right? One of these days I'll learn how to really market.
Yeah, on our side, I guess there's maybe 3 things. One, if you want to see our deal flow and not, let me know. Share your confirmation. Happy to share that with you and let you take a look at it and make your own opinion about whether you like it or not. With regard to events, we actually host a local meetup the first Thursday of every month. So this Thursday is going to be the first one. It's at Pitch 25, down closer to downtown, Minute Maid Park area. So coming out to that, you're going to find a lot of people in the multifamily space in particular, right? And one of the differences I would say between the multifamily and single-family events that you see out there, we have maybe smaller number of people, probably around 50 to 150 depending on the month. But you find a lot of quality people, very high quality, real players in the industry that are doing real deals and are looking to do more deals at these events. So that's on a monthly basis. In addition to that, we also host conferences throughout the nation, usually one on the West Coast per year, one of them in the Houston area, and one on the East Coast. Quest has been at plenty of those, so obviously you'll see some familiar faces. But at that conference, the one in Houston, it's usually in February, so it's a little bit of ways for this coming up one. But let me know. I'm happy to share that information with you. This past one, we had 600 people in attendance with another 200 people on the wait list just because we were at max capacity. So it is pretty popular. A lot of good people. The nice thing is if you come out to any of the other ones, we have one going on in Atlanta coming up, one out in Vegas. We just got done with one in Seattle. You get to meet a lot of people from across the country to see what they're all doing. Because every market's a little different. And there are opportunities outside just Houston, as great as it is here, that you can get to learn from and see what other people are doing. And despite us being a multifamily, we try to bring folks from other asset classes too, folks from single family, mobile home parks, parking garage investors, retail, office, even more unique niches like people who invest in airports, things that frankly, we don't participate in any of these directly, but we like to learn from these people, let them learn from us, ultimately see how can we work together to kind of elevate the entire industry and let everybody win. So we'd rather have small piece of much bigger pies across the board. So come out to one of those. If you're interested, you can go to disruptequity.com. You'll learn a lot about it there, or just reach out to me directly.
Awesome. Thank you guys so much for joining us. So go over a couple of the upcoming Quest events that we have. We got the Lunch and Learn with Paul M. Nados and Blink Lending coming up this Thursday. It's going to be in person only here at the Quest office. Also, as well, obviously we have our Quest Expo. This is going to be the biggest event that we host all year. All right, we have over how many confirmed speakers do we have? 30. Yeah, I think 34 is the last one. 34 confirmed speakers, tons of vendors. We're expecting hopefully 900 to 1,000 people to show up. This is going to be, like I said, the biggest value that we can offer you as a company. And on top of that, we have Emmitt Smith coming out, leading rusher coming out.
Also, who here has their ticket to the Quest Expo? Raise your hand. So if you don't have your ticket to the Quest Expo, we actually have some speakers in here. So Chris Bounds is a panelist here. Adam's a panelist here. Also, we'll have Emmitt Smith there, who, I'm not very familiar with football, but I hear he's an NFL Hall of Famer, so that's pretty cool. But if you haven't gotten your ticket yet, guys, we don't do often very many discounts. So right now, typically our best one is $30 off for your ticket, but if you're here tonight at the social, we have a new code that I generated yesterday. It's called Social 50, gets you $50 off. So that's our best deal so far. As we get closer to the expo, we're about 50 days or less out. So now would be the time to get it if you haven't gotten it yet. It's a really great event to go to, generate like really high business leads from there. People fly really across from the country to do this. One of my clients from back in 2018 flew in all the way from New York. So he had a blast there too. So if you're in the area September 23rd through 25th at the Westin Galleria, be sure to grab your ticket. $50 off is pretty good for the event we have, especially for all 3 days and a potential to meet Emmitt Smith. So that's pretty cool too. I think that's all I have for the expo.
And it is good. It's really good. I've enjoyed it every time I've been out there. Quality content and networking.
Yeah, this will be our first one bringing it back since after COVID. And I think, do we have something else for the guests who attended in person today?
So we have the Social 50.
Yep.
And then after that, that's really it. And then getting in touch with an IRA specialist. And if you decide you want a consultation with an IRA specialist, we do have a promotion going on right now. That would be multiples 22, so unlimited accounts. Basically, you can get a traditional IRA, a Roth IRA, a health savings account for you or your family, education savings account for your kids, grandchildren, anything along those lines. It all is just $100 for unlimited accounts. So that's going on all month long. So if you are interested in a consultation with an IRA specialist, I think like half of the area should have this little blue sheet right here. So if you do want a consultation, just fill out this blue sheet and drop it off at the Quest table when you leave. But other than that, I think that's all we got.
All right, perfect, guys.
And now I know it's late. Thank you first to all of our speakers. Let's give them a round of applause. So at the end of all our events, we typically do deal pitching. For anybody who is interested in coming up to the podium, you can grab a mic. You can talk for about 30 seconds, who you are, your contact, what you're looking for, and what you have to offer. So if anybody would like to start the deal pitching?
Nope.
I'll start since I'm here.
Yep, there we go.
Go ahead.
So I think these deals are going to be available for non-accredited and accredited investors, but TBD. But probably in the next 2 weeks or so, we're going to be announcing deals we have available. We just wrapped up one in Austin, so that's off the table, but we have one coming up in Dallas and one coming up here in the Woodlands in Houston. So multifamily properties, good-looking numbers, good cash flow. Part of our whole model is our deals have to pencil in based off of cash flow. Appreciation is nice, and we hope for it, of course, but that's some speculation, and you don't know what's going to happen ultimately. So we try to be conservative and say that ultimately, if the deal pencils in based off of cash flow, and then we get appreciation on top of that, that's just extra gravy on top of what was promised. So those are coming up in about 2 weeks. So if you're interested in those, let me know. Happy to get you on the list and make sure that you receive notifications of that whenever it is ready to go in about 2 weeks.
We just launched Invested Equities Housing Fund 1. It is going to be a diversified portfolio targeting affordable workforce housing. It's an evergreen fund, $100 million evergreen fund. It is for accredited investors only. And a lot of the benefits we have within this fund, it makes it look a lot more like a REIT, but with all the benefits of equity ownership. You can learn more about that at our website, investedequity.com, investedequity.com.
Anybody else? Yes, sir. Oh, yeah. Y'all come up.
Hi guys, I'm Jeff Davis. I'm with Bridgestone Capital, and I, like these guys, I raise capital for experienced operators, and we do have a couple of deals coming on in the next couple of weeks, one for accredited investors only, and the other for accredited and non-accredited investors. They are both here in the Houston market, and they're conservatively underwritten for the cash flow. Appreciation is fantastic and is gravy. They are one's for a 3-year hold and the other's for a 5 to 7 year hold. Contact me if you have any interest, just to look at it and see if it's something you're interested in. I have paper written a report, multifamilyadvice.com, and would like just to get on the phone and see if it's anything that you might be interested in. Thanks.
Awesome. Thank you, Jeff. Yeah, 1 to 2. There you go, no problem.
My name is Carmelo. I've been a real estate investor since I was 24 years old, so probably 26 years now. I started in single-family housing, and I actually stayed there. But 5 years into it, I got into assisted living houses. And I provide services for the senior care residents, I also provide housing for the mentally ill. The reason I did not go into the commercial space was because each bed cash flows about 30 to 35% depending on your occupancy. So I got out of the industry about 6 years ago. Now I'm back into it, and I'm looking to raise funds. I've got 2 properties under contract. I already have acquired 1 licensed Type B home, and I'm looking to expand again. At my largest capacity, I was about 60 residents under five roofs, and bringing in about maybe $800,000 a year. You get to keep about 25 or 30% of that. If you're interested, give me a shout. My name is Carmelo, Carmelo, and I can be reached at whoyoucallingcrazy@gmail.com. That is a real email. Right? Thanks.
Thank you, Carmelo.
I'll never forget that email.
Yeah, right.
I love that. I love that email. So I'm with ZT Corporate. Okay. I'm with ZT Corporate, and we have a healthcare opportunity to invest in some emergency rooms located throughout Texas. We have over 18 here in Texas right now, predominantly in the Houston area. And so we have a 2-year note investment, and that pays a fixed income. And so that can either be paid out monthly or that can be compounded. So for some folks that have retirement funds they want to use, they can, juice the return a little bit. So if you have any questions or you want to learn more, my email and my team is here, Sonia. My email is kgandhi@ztcorporate.com.
Awesome. Thank you. Anybody else? That's it?
No? All right. I actually forgot to mention. You want to come up here? No? Okay. Oh, okay, good. So another thing I forgot to mention when the expo was up is we're starting this new thing every month at the SDIRA Social. So if you come in person, we are doing a raffle for a free expo ticket, free general admission expo ticket. So I'm going to, because I kind of know the gist of it, I'm going to turn around real fast. I'm going to do a spin.
All right. Right.
Right there. Okay. Steve Johns. Right there? All right, free expo ticket.
There we go.
I'm going to circle this. So guys, we do this we're going to start doing this once a month. So the next expo or the next SDIRA Social is September 6th. We actually have one of our expo speakers there. Or one of the sponsors, it's Alex Buriak from Jet Lending. So make sure you come September 6th, same area, same time, same room, and see if you win your Quest Expo ticket. So Steve,
Awesome.
let me...
Well, guys, thank you for joining us.